So, your T account exercises. Um, I'll try a different approach with the T accounts, whereas instead of doing the transaction beforehand, I will be doing them step by step. So, you can attempt this before I start, or you can do it with me. Once again, choice is yours. So the first transaction says that you bought vehicles with cash for $500,000. Jesus, my English is running away with me. But anyways, so you bought vehicles with cash for 500,000 Namibian dollars. So now you have to identify um, what those different things mean. So in a transaction, you have two accounts. I already went ahead and at least added the accounts, the account names, probably adding the transactions one by one. So the two accounts you have is your vehicles and cash. What you can do to make it easier for yourself when you have a transaction like this, you can just indicate in pencil whether it's an asset, liability, or whatnot. So you can write in pencil, so you know under which T account or under what the T account falls. So vehicles and asset, cash and asset. So now when you go and draw up your T accounts, you know on which side your things increase and decrease. So I already added one of the accounts, which is your cash for $500,000. So the one T account here is cash. So we already established that cash is an asset, and your assets increase on the debit side and they decrease on the credit side. So seeing as we paid money for the vehicles, we paid the 500,000 Namibian dollars for the vehicles. Money is being spent. So you are using up 500,000 Namibian dollars. You can draw the labels for that are used in the cash book, or you can just imagine them, because basically the same labels apply where you would have your date, your description, and then your amount. You wouldn't have bank because again the accounts. So yeah, you'll then have your amount and then you enter the amount here. So what we'll do is you bought vehicles for 500,000 Namibian dollars. So you would enter it here under the 500,000 Namibian dollars, and then under description you would say vehicles. Okay, my apologies. I had to do something quickly. Where were we? So vehicles. So we said earlier that we bought vehicles for $500,000. So with cash. So your cash is decreasing. Your cash is an asset, so it increases on debit side, decreases on credit side. Now the reason why we write vehicles here is so that we can already do our double entry system. Even though both are assets, you would make separate T accounts for them. You could also just make one big T account and call it assets, but you want to be specific. You want to know how much value you have in your vehicles, how much value or how much cash you have, how much money you have in the bank, and all that. Traditionally, you wouldn't actually make T accounts for cash and bank. There is an ongoing argument in accounting over this, because your cash is already represented in your cash book, for example. But it's for the purposes of accountancy for lawyers, you still do it in your general ledger or in your T accounts, so that you can know or you can see the effect of the double entry system. Okay, let me just get this in right. So yeah, I had to add vehicles down here because I noticed I didn't add a column for vehicles. So vehicles is also assets, so increase on the debit side and decrease on the credit side. Again, we're just assuming that the left hand side is your debit side, so the right hand side is your credit side. So now your vehicles are increasing. The value of your vehicles are increasing by $500,000. And now, because you see you write it on debit side because your vehicles are increasing, and now you just write cash because you need to know how you came into possession of these vehicles for legal purposes, obviously, and for the purposes of accounting. So now you already have a debit for your credit, and that is the whole point of these T accounts. So now you can see, oh, so if you have your 500,000 here, then you will look, oh, look, your vehicle says, let me just also my write in the credit and the debit this side. Debit, debit. Okay. Second transaction. Um, Paid creditors via EFT. So your creditors are a liability, and EFT is another way of saying that you pay them through your bank. So your bank is an asset. You see, sometimes you need to go deeper into this thing. I don't know if Ms. Avrap will be this specific, but it's just to be safe. So you already have your two accounts because you need to identify your two accounts. Now you can see creditors. Creditors form part of your liabilities. Your liabilities increase on the credit side and decrease on the debit side. And then your assets once again increase on the debit side and decrease on the credit side. So you pay the creditors via EFT for the value of $20,000. So now you go to bank, and seeing as you're paying them, you are your bank is decreasing. I'm just writing in again because we already established this is an asset. So it's increase on the debit side and decrease on the credit side. We already established that we paid money to the creditors, so money is leaving the bank, so your bank is decreasing. So on the credit side, you just write your creditors. You need to know where the money is going. And for the amount which was $20,000. I messed up my T account a little bit with the space on the side, but this is all is important. You just need to add these things. And again, your debit and credit. I forgot to add this beforehand, but again, it's so important to add both the debit and the credit and to show your increase and decrease. And you won't get marks for this necessarily, but it's just so that you don't go and make unnecessary mistakes in the exam. Continuing, so you have your creditors here now, and we established earlier that your creditors increase on the credit side and they decrease on the debit side because they are a liability, and your liabilities increase on the credit side and decrease on the debit side. So seeing as you are paying your creditors, when you pay money to a creditor, they decrease. They don't increase, they decrease because creditors are people whom you owe money to. It's like, say for example, you owe me $50. If you pay me your $50, you don't owe me money anymore, so your creditors decrease. So this is why they decrease on the debit side. So now you write the amount for what it's worth, the 20,000, and then you write how you paid them, which was you paid them via EFT, which falls under bank. This is a very rough T account. I actually don't like doing it rough like this, but I don't want to overcomplicate things right now. I will do another T account where I'll add the columns and stuff just so it can make a little bit more sense. So the third transaction is cash sales for $10,000. So cash is an asset and your sales is an income. So again, assets increase on the debit side and decrease on the credit side. Your cash is increasing, and sales is an income increase on the credit side and decrease on the debit side. So cash sales. So we made money. We made $10,000, and we made it via sales. So and we add the sales. So now we need a new T account for sales. Sales, which was an incomes increase on the credit side and decrease on the debit side. Just writing my DR and my CR. And so the sales seeing as you had more sales, the sales increase. So they increased by $10,000. And how did you make those sales? You made them via cash. So then you see again, double entry system, 10,000 there. There's your debit, there's your credit. Bad debts of 5,000 Namibian dollars were written off. So bad debts is actually an expense. We see it as an expense or yes, or a liability. Not actually a liability. We see it as an expense because you're losing money. You don't have, like, liabilities are usually in the instances where you need to pay someone money. So apologies for that. It's not a liability, it's an expense. Bad debts is an expense. So just write here expense or bad debts so you don't get confused later. And then the other amount that gets affected by bad debts is actually your debtors. So bad debts are when your debtors, as I stated earlier, is when you lose track of your debtors. So like they can't pay you back the money which they owe you. Oh wow, I actually don't have a thing for debtors either. Let me just throw a new line here. This is gonna look very ugly under purchases because I know purchases should only have one entry. Debtors. Okay, let's start with the bad debts. So your bad debts is an expense. We know expenses increase on the debit side and they decrease on the credit side. Almost got confused there. Debits, credit. So seeing as your bad debts are increasing, we wrote off bad debts with 5,000 Namibian dollars. So your bad debts increase with 5,000 Namibian dollars. You can then just write in debtors. So you can know where to edit, and your debtors is an asset. Assets increase on the debit side, decrease on the credit side. So your debtors actually decrease when you have bad debts because they can't pay you back anymore. You are hoping they could pay you back and they can't pay you back, so you lose out on your money. So you need to write off these debtors. And as a result, you would end it on the credit side because they can't pay you back. Bad debts. Oh, my handwriting is starting to get very ugly here. Okay. I'm almost halfway through. I don't want to make the videos too long, but I don't want to miss any important details. So if you feel like you get the gist of it, then you can just fast forward to the transaction you want to see or whatnot, or to the end where I have completed the accounts. But yeah. So transaction number 5 says capital contribution via bank for 50,000 Namibian dollars. So capital falls under your owner's equity. Just write OE for owner's equity, and your bank is again assets. So this means that the owner increased their capital contribution by $50,000. So they transferred 50,000 Namibian dollars to the business bank account. We already have a bank T account, so it increases by 50,000. And what did it increase by? Or what increased it? Your capital increased it. And just write. So in your T accounts, you usually write the reason for the amount being there. So now again, you have your capital because that's where you got the 50,000 Namibian dollars from. Yeah, it was 50,000 Namibian dollars. Then you create a new T account called capital. Capital is owner's equity. Owner's equity increase on the credit side and they decrease on the debit side. Just to make sure of that. Yes, you see once again the increase on the credit side and decrease on the debit side. CRDR. So your capital increased, meaning you need to add that 50,000 on the credit side. And how did it increase? It increased via your bank because the owner increases capital via the bank. Number 6, purchase stationery with cash worth $500. So stationery is an expense and cash is an asset. So your stationery expenses increase on the debit side and decrease on the credit side. Assets increase on the debit side and decrease on the credit side. Thing with accounting is you're going to parrot stuff a lot until it just becomes second nature. So the amount for that stationery was $500 million that you paid for. So your cash is decreasing. What was cash? Yeah, sorry, I was just not sure about that now. So it's decreasing with 500 cash. I was actually supposed to write it down here. And that money went towards your stationery. Now you have to create a new T account for your stationery. Stationery is an expense. Expenses increase on the debit side and decrease on the credit side. So your expenses increase, so it has to increase on the debit side. What did you buy the stationery with, or what caused it to increase? Your cash, because you use cash to buy that stationery worth $500 million. Again, it all boils down to the double entry system. This $500 needs to appear, it's on the debit side, so it needs to have its credit, and you find its credit all the way over here. Almost done. 3 more transactions. So water and electricity paid cash, $3,000. Water and electricity is an expense and cash is an asset. Again, for $3,000. So wait, oh, my days, my brain is starting to fry up. Anyways, okay, so we said it's cash. So you pay $3,000 for your water and electricity with money. So water and electricity, because that's where that money went. And you need to create a new T account for that water and electricity, which is down here. Water and electricity is an expense. The expenses increase on the debit side and they decrease on the credit side. So seeing as your water and electricity account increases because you used money for it, it increases on the debit side. And you used cash to pay it, so you enter the as cash for the value of $3,000 Namibian dollars. Last two, almost done. You deposited 50,000 Namibian dollars cash into bank. So this is actually both assets. So you took the money that you had on hand for 50,000, for 15,000 of it, and you deposited into your bank account. So your cash decreases by 50,000 Namibian dollars. And then what caused it to decrease? Your bank. Because you took the money and you went to go deposit it into your bank account. Usually, when something like this happens in the cash book, it's called a contra entry. I will look to do an example of this if I should do another cash book example. But basically, this means that your assets remain the same. All it happens is you just place the money that you had on hand into your bank account, or vice versa, where you withdraw money from the bank account so that the bank or so that the business can have cash on hand. So your cash decreases by 50,000 Namibian dollars because you deposited into your bank, and as such, your bank increases with 50,000 Namibian dollars because you deposited cash into it. And the last transaction says you took a bank loan of 100,000 Namibian dollars. Your loan is a liability. Why it's a liability is I said earlier, liabilities are usually referred to things that you have to pay. So they're not quite the same as expenses. You don't have a choice to pay your liabilities, if I can put it that way. Most times with your expenses, you can choose to pay them or not. Like water and electricity, you can choose to pay it. If you pay it, fine, you still have water and electricity. If you don't pay it, they cut your water and electricity. Liabilities, however, different, because if you take a loan from a bank, you have to place down something as security. If you don't pay back the loan, they come after you and they take whatever you placed, whether it be your house, your cars, or whatever. So just to provide some context towards a loan is a liability, so you have to pay it back. You took a loan for $100,000. Usually when it's a bank loan like this, it just means the money goes into your bank account. Sometimes they might say took a bank loan for cash of $100,000, then you know, okay, the money was withdrawn. So then it gets entered into cash, but because it's just a bank loan, it goes to your bank. So bank is an asset, increases on the debit side. You took a loan, so the reason why it's increasing by 100,000 Namibian dollars is because of this loan you took out, obviously, and then you need to create a new T account. So as you said earlier, your loan is a liability, and as we can see, your liabilities decrease on the debit side and they increase on the credit side. So it's so important to always to practice these things or to write this down somewhere, because if you remember this, you can basically do all of this, assuming you know what account falls under what. So this as well as your sub accounts are very, very important. So your liabilities increase on your credit side and they decrease on your debit side. And seeing as you took out a loan, your loan amount increases by 100,000 and you took that loan out directly into your bank. And it should be the last transaction for your T accounts. So in short, all of this, you can just compare this now if you decided to do this ahead of time. All of this basically boils down to the double entry system and whether or not, oh, this is going to annoy me now, sorry. OCD. And whether or not your transactions were entered correctly. Usually, if your debit doesn't have a credit somewhere, it means either you missed a transaction or you entered it under the wrong account. So this is why the double entry system is so crucial towards accounting. So you can just take one last look through everything. Everything has its debit. Every debit has its credit and every credit has its debit side. So that's basically the T accounts or your general ledger entries.